ใช่ 7 Secret Tax Loopholes. Wealthy Parents Exposed to College Kids Only. My CPA dad showed me deductions at 19 that most people don't learn until their 40s. And the worst part? These aren't illegal. They're not even gray areas. They're sitting right there in the tax code, waiting for anyone smart enough to use them. But here's what made me angry when I finally understood this. The IRS doesn't hide these loopholes. Wealthy families just pass them down like secret recipes while the rest of us overpay by thousands every single year. I calculated it last month. If I had known what I'm about to tell you when I was 18, I would have an extra $47,000 in my bank account right now. That's not an exaggeration. That's math. So I'm going to walk you through the exact 7 strategies my father drilled into me before I even finished my sophomore year of college. And look, number 5 is the one that rich kids use to literally get paid by the government while they're still in school. We'll get there. But first, you need to understand why this information stays locked in certain families. It's not conspiracy. It's simpler than that. CPAs charge $300 an hour. Financial advisors take a percentage of assets most college students don't have. So unless your parents already know this stuff, you're invisible to the system designed to help you. That changes today. By the time this video ends, you'll know more about legal tax optimization than 90% of adults twice your age. And that last strategy, the one about retirement accounts, it's going to sound illegal when I first explain it. It's not. But it might be the most powerful wealth-building tool you'll ever learn. Let's start with the one that saved me $2,400 my junior year, the Lifetime Learning Credit. Now, you've probably heard of education tax credits, but here's what nobody tells you. There are 2 of them, and most families pick the wrong one. The American Opportunity Credit gets all the attention because it's worth up to $2,500. But it has restrictions that disqualify a huge number of students. You can only use it for 4 years. You need to be pursuing a degree. And you have to be enrolled at least half-time. The Lifetime Learning Credit? 20% of up to $10,000 in qualified education expenses. That's $2,000 back. No limit on how many years you can claim it. Part-time students qualify. Even if you're taking 1 class at a community college to learn a skill, you qualify. My roommate was taking a coding boot camp his senior year. Didn't even think about taxes. I showed him how to claim it on his return. He texted me in March saying the IRS deposited $800 he didn't know existed. Here's the strategic part wealthy families understand. You coordinate between parent and student returns. If your parents claim you as a dependent, they take the credit. But if your income is low enough and they don't claim you, you take it yourself. The math changes based on who's in a higher tax bracket. My dad ran both scenarios every single year. 1 year, it made sense for him to claim it. The next year, it made sense for me. We saved an extra $400 just by doing that calculation. Most families never run the numbers. They just pick one approach and stick with it forever. Now here's where it gets interesting. You know how everyone tells you to get a job in college? Great advice. But nobody mentions that where you work matters almost as much as whether you work. I'm talking about the federal work-study program, and the tax advantage hiding inside it is something I didn't fully grasp until my dad explained it over Thanksgiving dinner my sophomore year. Work-study wages are exempt from FICA taxes if you're enrolled at least half-time. That's 7.65% you're not paying on every single paycheck. Sounds small until you do the math. Let's say you earn $4,000 through work-study during the school year. That's $306 you keep that a regular campus job would take from you. Over 4 years? That's over $1,200. But here's the real strategy. You combine this with something called the Savers Credit. If your income is low enough, and as a college student it probably is, The government will literally give you a tax credit for putting money into a retirement account. We're talking 50% of your contribution, up to $1,000 credit. So you earn $4,000 through work study, you put $400 of it into a Roth IRA, and the government hands you $200 back at tax time. You just got paid to save for retirement. I started doing this at 20. By the time I'm 60, that $400 will be worth over $8,000, tax-free. And it cost me effectively $200 because of the credit. This is what wealthy families teach their kids at the dinner table. It's not complicated. It's just not advertised. Okay, this next one is the strategy that made me realize my financial education growing up wasn't normal. And it's probably going to change how you think about your side hustle. If you make any money outside of a regular job, whether that's freelancing, selling stuff online, tutoring, whatever, you can deduct your business expenses. But here's what most people miss. You can deduct things you were already going to buy. I started a small video editing business my junior year, made about $6,000. My dad sat me down and we went through what I actually spent to make that money. My laptop? Partial deduction, based on business use percentage. We calculated I used it 60% for work, 40% for personal. That's 60% of the cost, deductible. My phone bill? Same calculation. Internet? Same thing. Even a portion of my rent could theoretically be deducted if I had a dedicated workspace. I ended up deducting about $1,800 in expenses I would have paid anyway. At a 12% tax bracket, that saved me $216. Not life-changing, right? But I was 21. I did this for 3 years of college. And here's the part that blew my mind. If my business showed a loss, I could use that loss to offset my other income. There are rules about this. You can't just create fake losses forever. The IRS requires your business to show profit 3 out of 5 years. But strategically, you can time your expenses. Big purchase in a year you made more money? Smart. It offsets more income. If you're making content right now, even if it's small, start tracking everything. Every piece of equipment, every software subscription. There are tools that make this almost automatic. I actually use AI voice software now for some of my content, and I ran across 11 Labs recently at try.11labs. IO 2P109Y92JL1. Fully deductible business expense if you're using it to create content that generates income. That's the mindset shift. Everything becomes a potential deduction when you operate like a business owner. If you want more of this, hit subscribe. I drop one of these every single day. Here's something you can do literally today. That will save you money this year. Track your student loan interest, even if you're not paying it yet. When you start making payments, you can deduct up to $2,500 of student loan interest from your taxable income. This is an above-the-line deduction, which means you get it even if you don't itemize. But here's the tactical part. If you're currently in school and your loans are accumulating interest, that interest might be deductible in the year you pay it, even if that year is later. So keep records now. Know exactly how much interest accrued during school. When you graduate and start paying, your servicer will send you a form, but that form sometimes misses interest from certain periods. I've seen people miss hundreds of dollars in deductions because they trusted the form instead of their own records. 20 minutes of tracking now equals potential hundreds in your pocket later. Also, if your parents paid your student loan interest for you, you can still claim the deduction. As long as you're legally obligated on the loan, the IRS treats it as if you paid it yourself. My dad paid 2 months of my interest once when I was between jobs. I still deducted it. Perfectly legal. Now here's the section most finance content skips because it requires you to think long-term. And I know, you're in college, retirement seems like a fictional concept. But this is the strategy that separates people who retire wealthy from people who work until they're 70. The Roth IRA backdoor doesn't require a high income. It requires low income. And right now, while you're in school, you have something millionaires would pay for. A tax bracket so low that it's essentially free to load up a Roth. Every dollar you put into a Roth IRA right now grows tax-free forever. When you're 60 and you pull it out, you pay nothing. Zero. If you put in just $50 a month during college, that's $2,400 over 4 years. At a 7% return, that becomes over $26,000 by retirement. You paid zero taxes on that $23,000 gain. Now imagine you waited until you were 35 and in a higher bracket. Same $50, but now you're choosing between Roth and traditional. You have less time for compound growth, and the math gets worse in every direction. This is what my dad meant when he said your 20s are the most expensive decade to waste. Not because of what you spend, but because of what you don't invest, when your tax burden is basically nothing. Remember when I mentioned that one strategy sounds illegal but isn't? Here it is. Gifting strategy combined with the kiddie tax loophole. If your parents have investments, they can gift you up to $18,000 per year without any gift tax implications. But here's the play. If they gift you appreciated stock instead of cash, and you sell it while your income is low enough, you might pay 0% capital gains tax. The threshold for 0% long-term capital gains is currently around $44,000 in taxable income for single filers. As a college student, you're probably way under that. So your parents gift you stock they bought years ago, you sell it, pay no federal capital gains tax, and now you have cash. They would have paid 15 or even 20% on that same sale. This works best when coordinated across multiple years. You don't want to accidentally push yourself into a higher bracket. But done correctly, a family can move tens of thousands of dollars in gains from a high bracket to a zero bracket, completely legally. This is generational wealth transfer in real time. It's happening in wealthy families constantly. And now you know how it works. Going back to what I said at the beginning about the $47,000 I calculated, this strategy was about $18,000 of it. 3 years of coordinated gifting and selling, managed by my dad, executed while I was a student with minimal income. So here's the truth that took me years to fully